On this episode of the Property Nerds podcast, we've got Tuan Duong from Duo Tax Quantity Surveyors. Now, if you're wondering what a quantity surveyor is, we're going to unpack it in this episode and show you the importance of depreciation and how you can actually increase the claims on your investment property to improve your cash flow. It's a mistake that many people make in terms of forgetting about this critical part of property investment so they can actually better hold their properties. Remember, when it comes to property investment, holding your properties for the long term is what truly unlocks capital growth and compounding wealth generation. That won't happen though if you don't have the cash flow to stay afloat and hold things the whole way through. So Tuan will unpack more on this from residential property, commercial property, and even some of the mistakes many people make when it comes to actually claiming depreciation on their property. So let's get into it.
Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
Tuan, welcome to the Property Nerds Show, mate.
Thank you for having us, Arjun. It's a pleasure.
Mate, it's been 7 years since I've known you. You've played a tremendous part in our journey at InvestorKit, where we see people's cash flow positions, technically lives change during this higher interest rate environment because, you know, to be able to make sure people can hold portfolios is probably the most important thing to scaling a portfolio, compounding wealth as you know it. But they do it to this thing called depreciation. And your team at Duo Tax helps them in terms of getting the right claims on their properties. But for those who are unaware of what depreciation is and how it works, could you give us your 30-second view of what depreciation is and how it works for property investing?
Yeah, sure. Thanks, Arjun. And depreciation is essentially the wear and tear on the building and the fixtures and fittings. So anything like oven, range hood, cooktop, air conditioners, carpet, they're all depreciable and they're called fixtures and fittings or plant and equipment. Now, the wear and tear on that, we can put a dollar value on that. And the job of a quantity surveyor is to work out the depreciation value. And depreciation then is claimed as a tax deduction. But the great thing about it is it's a non-cash deduction, right? So you don't actually have to fork out money to pay down this building in order to claim it. That's why it's a non-cash deduction. And it's like free cash flow for the property. And it's helping you boost that cash flow over the life of the property. And hence, it's a great negative gearing tool. And helping property investors get ahead.
Now, I love how you said it's a tool. And I think that's key, right?
Yep.
Because when it comes to property investing, people need to also make sure they think of depreciation as a way to support their journey, not the journey. There is different types of depreciation too. Residential, commercial, there are different types of property. How does depreciation differ between the two types of property?
Prior to the 2017 legislation, so 9th of May 2017, legislation changed. And prior to that, all properties were the same. If you bought a property brand new or secondhand, you could claim on plant and equipment or capital works. Capital works being the building, bricks and mortar, slab framework, glazing, doors, they're all capital works. And you claim them exactly the same. However, after the legislation changed in 2017, now if you buy a secondhand property in Australia and it's a residential property, you can no longer claim plant and equipment depreciation. So all those stuff I was talking about that's motorized or carpet, even loose furniture, they're all plant equipment. You can no longer claim them in a secondhand setting. So if you purchase it as a secondhand or existing property, you can't claim them any longer after that date. However, capital work still remains the same. So the building, you can still claim 2.5% to 4%, depending on the use of the building. Industrial buildings, for example, will have a higher yield of return in terms of claiming and depreciation of 4% because of the usage being manufacturing facilities and whatnot. But when it comes to claiming for commercial, you can still claim on secondhand plant equipment. So that's the biggest difference.
That's a substantial claiming difference then when it comes to commercial versus residential, right?
And we're talking thousands of dollars, Arjun.
Lots of dollars. Yeah, and I think on that note as well, what people don't recognize is that commercial assets are quite positive cash flow. So you're actually reducing that tax event because of the depreciation being so high on that positive cash flow. It's actually aiding the reduction of it. Whereas on, say, residential and it's negative cash flow, the depreciation might be a little bit different. It's increasing the paper negative cash flow to be able to have some more returns back to you, right? So that core difference. With depreciation, one more thing I wanted to cover off was the journey of actually getting your hands on the benefit. Could you quickly give us like a run through of how someone can go from, speaking to your team, what does the team do, turnaround time, and then like what is the tangible thing a property investor gets, and just that flow, because we're talking about the great benefits and how it can help, but what does that flow look like?
Yeah. Essentially, a depreciation schedule has to be prepared by a quantity surveyor.
Yeah.
A quantity surveyor is a construction economist approved by the tax board, which essentially means that you go to someone that's qualified to give you advice around what your building costs. What is your building worth today, whether it's brand new or secondhand? And then using that advice, we will then value. So first step is, of course, you come into Duo Tax referred by Arjun, for example, and then your first challenge is, okay, I've got a property. I don't know what it's worth in terms of depreciation or whether it's even worthwhile getting a depreciation schedule because it's going to give me this tax deduction, but what am I paying money for if there's no tax deduction if it's too old? That's the very common question. So what we do is we get an inquiry from an organization like Arjun's, and then they might say, okay, I've got a property, here's the address, I'm about to settle on it. Can you work out if there's any depreciation so we can work out if we need to get an inspection done and proceed to get a report? Yeah. We take that address, we'll then shop it through RP Data or one of these online services. Now there's so much availability for data in terms of photos, which indicates, okay, have there been any renovations? How old is the property? How large is the property? What type of build is the property? And then we get an indication, okay, well, this property is going to yield you $10,000 per year in tax deductions for the next 2 to 3 years as a minimum. That gives you an indication that I know exactly what I'm going to get back as a tax deduction, and hence my refund might be $3,500 or $4,000 if I'm PAYG, which means that, yes, for $600 for a report, it might be worthwhile. Let's go ahead, $600 investment, which you pay one time. Yeah. And then you say, yes, Tuan, we'd love to go ahead. We go out there, inspect the property, survey it, make sure we measure how many downlights, how big is the building, how many windows, how many doors, and then we work out a build cost and then depreciate that, get you a schedule that will last you 40 years from the date that it's built. Which means that you'd only organize a report once, and because it's a forecasting report, it gives you a schedule of how much depreciation you get over the life of the building, and that's it. Unless you do another renovation, will you need to get another report done? So that's the value of the negative gearing tool known as the tax depreciation schedule.
So when you do a renovation and then you do another depreciation schedule, is there anything that you can't claim?
With a renovation, as long as the renovation is completed with the intent to use for income producing purposes. So if you renovate a property and improve it and do an extension or fit out the garage and turn it into a granny flat, as long as the intent is always to use it for the intent of rent, then you can always claim full depreciation. So even though the property you bought might be secondhand and you bought it in 2025, if you do a depreciation schedule on that today, you would lose all the plant and equipment claims because it's secondhand, but you can still claim the building. However, when you do the renovation on it, it's considered brand new because you now have purchased everything from a brand new retailer, for example, or a builder. Then you can claim everything as a depreciating asset, which is considered Division 40 for those wanting to know exactly what that term means for plant and equipment claims.
I love how you can remember those division numbers and stuff. Huh? It's like a librarian. You got these codes and everything all done. So Tuan, on the renovations question, Jack mentioned you might be getting rid of stuff that when you're ripping out a bathroom or a kitchen, but it might not be things that are super old either. What happens in that scenario? Because you're losing previous depreciation stuff that you claimed on. How does that all work?
So essentially, because the property might have a cutoff date of 1987, that's the cutoff date for original structure. Now, if you go rip out a joinery in the kitchen or bathroom, and that might be worth, say, $15,000 in scrap value, and the building's still claimable under depreciation, but you still want to make a refresh in 2025. Well, when you rip out that joinery in the bathroom, in the kitchen, might be a residual value of $5,000. You could claim that as an immediate scrap value because it's still depreciable. Had it been left there,
so many people don't know that, right?
It's a no-brainer. So not only do you get to claim depreciation on the alteration or the renovation, you can also claim the scrap value on what you've pulled out of the property. So it's always worthwhile checking with the quantity surveyor, hey, how much depreciation is there worth in this? Can I claim it as a scrap value because I'm about to demolish it? And get the quantity surveyor to assess it over the phone before you even start doing the work.
So pre-reno, post-reno, that's both the timings because most people just come at post-reno.
Correct.
But they don't recognize if they come to you for pre-reno advice too, difference maker.
And it's a big deal. I mean, sometimes people are pulling down a house or they're pulling down a whole, gut the whole house just to renovate the whole place, right? And you're spending a couple $100,000 to, spruce it up a bit. Well, there's potentially $50,000 worth of scrap value. And we've done plenty of reports to help people with this. $50,000 is a lot of money in terms of cash flow.
It's a huge amount of money.
Loving the show and keen to invest? Well, book your free discovery call and we'll actually walk you through how to build a high growth portfolio without all the guesswork. Just jump onto the link in the show notes or visit investorkit.com.au to book your discovery call. And now let's get back into the show.
I had a question around, I guess, what we're seeing a lot in when we're building our portfolio plans. There's usually the old motto of never sell.
Yeah.
And that's been around when it comes to property for ages. But when we build our portfolio plans, we usually see that, sometimes there is a time and a place to sell. And depreciation sounds really good in terms of what you've mentioned, all of the deductions that you get and the cash that you're getting back. But what would investors really need to know about potentially selling and, repaying back depreciation?
Yeah, it's a one that you definitely want to check in with an accountant. But from my experience, I've had to sell properties before, and the situation is that you've got to look at tax depreciation as a cash flow tool. It's not free money, right? When you're claiming depreciation, essentially the depreciation is the most aggressive in the earliest years of owning the property because the plant and equipment has a much shorter effective life compared to the building, which means that you're getting a lot of this cash flow earlier on, and it helps boost your tax deduction or the cash flow, which means that you, at some stage when you sell the property, there is some sort of adjustment.
Yeah.
So if you've claimed 50 grand on the building, my experience is that when you go to sell the property, that you have to add that back on, because essentially if you've got $1 million property, right, and your building is worth $500,000 and we claim depreciation of $50,000, the building's only worth $450,000. So when you go to sell that property for $1 million, you've actually made a gain, because that means the property is only worth $950,000, right? Because you lost that $50,000 in claims and depreciation. So when you go sell for $1 million, you've made a gain of $50,000. So that's a lot what people don't forget to miss out on, because they forgot to add back the depreciation that they've claimed. And so there's this adjustment that has to be made when you go to sell the property for capital gains or capital loss, because you are claiming that upfront, the depreciation. So it's something to be careful of.
Now, I know accountants are the best place for going for the full guidance, but that isn't going to be the whole amount, right? Because there's still CGT exemption when they calculate it. So am I right in saying that, let's just hypothetically say $1 million property grew to 1.1 and you sold it at 1.1. Let's imagine there's no sales agent cost, anything like that. No, hence why I speak to your accountant.
Yep.
That $100,000 gain is there, but you also had $50,000 of claimable depreciation. Pre-CGT discount, I guess they're seeing it as a 150 gain,
yes,
right? And that's where that payback comes in that tax. But if it's halved on CGT, is the 150 halved or just your actual gain halved?
Yeah,
right?
so the 150 is halved,
right?
And which means that is exactly right. And in that, if you own it in your personal name in 2025 and you go to sell, you're entitled to then only paying half of it back, but you're entitled to claim all of it up front. And that's where the benefit of depreciation is that you don't have to pay all of it back at the individual level.
Correct. And that's important to know, because then that way you're not like thinking it's something gone from you. It's still a benefit in favor. Two last things I want to touch on. And one is more from like an understanding perspective. And I just want to make sure I understand the role depreciation plays and why it even exists to begin with. I feel that it's such an important thing that the government does. And the reason why is they're looking at it from this perspective. We, the government, are not providing housing in Australia in terms of the public housing for rent or rental housing at scale as the way private landlords do. So to incentivize a landlord to be an investor, we're allowing them to make claims on things like the things that depreciation covers to enhance their ability to hold it, because they're contributing to actually having a rental property. And also when they build new, for example, which is why new has heightened depreciation, or renovate, they're supporting trades, they're supporting product, they're supporting trade to occur, supply of goods, all that sort of stuff. Am I understanding right that, the whole industry is there from that purpose to go, well, property investors supply rental housing, and this is why depreciation is given in the first place by the government in terms of a claim that one can make?
Yeah, highly subjective, and of course there is no gospel as to why they have the negative gearing policy, but I truly believe the same in that if we look at the problems now post-COVID, in that the cost of materials for construction has gone up dramatically, service in general has gone up dramatically, including materials. So what's happened is then there's this massive pressure on the government to now allow people to push more development. Development applications and council approvals aren't being pushed out fast enough to allow the private sector to provide the housing. So then there's pressures on the government now to release that and ease that to allow more housing, because housing there's a real problem in this country. And so I truly believe that, yes, the private sector is heavily relied on to provide housing. And if we don't give that allowance in terms of negative gearing and whatnot, to give private investors or private landlords now the opportunity to, move forward with the investing strategy, well, there's going to be this housing shortage. It only gets worse over time. Yeah. So I do believe that.
Absolutely. And it just shows that is like, whilst we don't love to praise the many things, government do or don't do, this is one of those things where it's helping many Aussie investors who are playing that role, playing that part. And then at the same time, it circles back in terms of the economy, right? So the other thing I wanted to talk on was older properties. Older properties it's a big issue I find many people make. And I just want to see if you see the same issue quite often. I don't think it's worth submitting a depreciation report. It's an older property, not a new one. I don't think it's worth me getting something done. I don't think you'd get anything, right? There's nothing to claim. Is that true? Like for older properties?
Yeah, it can be true. But it's taken a lot of guesswork. If you decide that you don't get a depreciation schedule, it's a lot of money on the table you miss out if you make the wrong decision. And of course, in 2025, the access we have to resources like RP data, CoreLogic, pushing out really good information in terms of what year was your property built. So any property you buy in Australia right now, and even an apartment, commercial property, RP data most likely will give you the build year. Yeah. And if it doesn't, council will. So we can contact the local council to find out when the property was built, and that will dictate when you can claim, how much depreciation you can claim, what you can claim on, whether it's plant equipment or just the building. And then of course, these photos that are provided, because every time you rent out your property, sell your property, release your property, there are updated photos. Well, it just takes a set of photos that indicate, okay, well, there's renovations or alterations on this property. You're eligible for $2,500. And to you, it might be like, oh, what's $2,500? But if you go see an accountant and your accountant goes, mate, you're on the 47% tax rate, that's $1,250 in your pocket every year from just forking out $600. That is also tax deductible on the depreciation schedule, which you only do one time.
One-off event to get that report.
And you get $2,500 for the next 10 years. He says, well, it's a no-brainer. So it's really making sure the numbers stack up for you, just like property is, right? End of the day, depreciation's no difference. As long as the numbers stack up, and getting that advice from a quantity surveyor up front without paying a fee is free, which is awesome. And so I think it's a no-brainer to take advantage of these things.
And so if I'm thinking of a property checklist, it's almost like 1987 built onwards, definitely get it checked.
Yeah.
Pre-1987, but renovated, still get it checked if in recent times. Commercial, most definitely, and the new build housing. So you're covering all bases, meaning in all bases, like if it's a property pre-1987 and it's not renovated in any way in the last few years, that's probably the only circumstance where that occurs, right?
Becoming becoming more rare, right, as time goes on, because as
you need to hold on to that place, right? You need to renovate it to hold on to it.
Make it saleable, rentable. So that's right. Definitely, it sounds like you've known me for so long. You've literally just spilled all the beans, which is great. This is what the audience needs.
Oh, absolutely. I think so. If you're on the fence sitting there and you're going, look, I've understand now the importance of depreciation. Silly me for not getting this claimed or having that understanding before. I hope this podcast helps you in getting that. But Tuan, if anyone else wants to reach out, whether it be us or anyone else in terms of tuning into this podcast, how can they get in touch with your company?
Yes, so just reach out to duotax.com.au or tuan@duotax.com.au and just mention Arjun, InvestorKit. We've got some specials that we, of course, have some exclusive pricing for your team and your clients. And, of course, we'd love to assist them, and it costs nothing to find out what depreciation they're eligible for.
Amazing. Thank you so much for the knowledge, mate. It's been really helpful, and I hope you've enjoyed another episode of the Property Nerds podcast. Thank you so much for tuning into this podcast. To hear more like this and to help us spread the word, don't forget to leave us a rating and follow along for our next episode.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Game over.